Well, good afternoon, everybody, and welcome to this Institute for Policy Research event. My name is Nick Pearce. I'm a professor of public policy at the University of Bath and the director of the Institute for Policy Research. And I'm delighted today to welcome to speak to you Adrienne Buller, who is director of research at the progressive think tank Commonwealth. Commonwealth is a relative newcomer to the think tank world, but made a big impact in a relatively short space of time. It focuses on questions of ownership, particularly in the economy, building a democratic economy. And Adrienne herself has worked extensively on questions of climate change and the relationship between ownership and control in the economy and the institutions and infrastructures and resources we have to deal with climate change. We are, of course, just coming off the back of COP27 in Egypt, to be welcomed for the establishment of a loss and damage fund, but in many other areas, a disappointment to those wanting to see stronger action. No resolution on peak emissions by 2025, nothing on phasing out fossil fuels, still very limited adaptation funding commitments against the promised $100 billion fund. So some real challenges still for policymakers around the world. And one big question is, how compatible is capitalism with tackling climate change? Is there such a thing as green capitalism that is a plausible route forward for humanity in addressing the climate challenges it faces? So that's a big subject, and one that Adrienne has addressed in her recent book, The Value of a Whale, on the illusions of green capitalism. She's going to speak to us about that just now. Just to say to everybody, if you've got questions, put them in the Q&A, and when Adrienne has finished speaking, I'll take questions through, we'll put them to Adrienne, we'll have a debate and discussion in the time we have after that. So please do put forward your questions, things you want to ask, debate, discuss. I'd be very happy to do that once we've heard from Adrienne. So enough from me. Adrienne, a big welcome to you. Thanks for joining us today, and I'll pass over to you now.
Great. Thanks so much for having me, and thanks for being here, everyone. As Nick said, I'll just walk you through some of the core arguments of my recent book, which is called The Value of a Whale, published with Manchester University Press. And broadly, this is just going to be an account of a new phenomenon that I think many of us will probably have observed, which is a palpable shift in the engagement of sort of the private sector, of corporations, of financial industry with the climate crisis. And I'll move into that now. I'm just going to do the slightly awkward thing where I begin to share my screen and open my slides. If you just bear with me. All right. And hopefully that is working. I can't see anyone to confirm whether or not it is, so I'll just forge ahead unless I hear otherwise. So ultimately, the reason behind writing this book, as I noted, came from an observation that I'm definitely not alone in making, which is that there's been a clear shift away from sort of an era of overt obstructionism of climate policy and sort of very overt kind of crude science denial, particularly among, we can think of the big fossil fuel giants, et cetera, and towards a genuine interest on the part of the private sector and particularly the financial industry towards shaping the trajectory of decarbonization and sort of shaping the way that policymakers are responding to these crises. And this here is just a quote from Larry Fink, who's the CEO of BlackRock, which is one of the world's largest financial firms, which I think really captures that essence, which is that, we are now focusing on sustainability, not because we're environmentalists, but because we are capitalists. And as just a brief bit of context, part of this insight arose from work that I was conducting several years ago at a nonprofit, which served as a bit of a sort of watchdog and consultancy to the finance sector. And my role was to engage with investors on how to sort of invest sustainably, how to align their portfolios with various climate scenarios, and how to use their position as shareholders to try and sort of bring about decarbonization. And had this kind of strange sensation while conducting that work where, my real concerns came not from sort of greenwash and bad faith actors, which, exist and are important, but broadly what I felt was sort of a misapplication of effort based on sort of misguided understandings of how sort of finance works and what the kinds of solutions should be to the pressing questions of sort of climate and ecological crisis. So the kind of driving question of the book and partly of this lecture is, with all of the kind of interest that we have, with every COP that we have every year, with the, unprecedented degree of public concern over these crises, how do we remain so off track? And again, there's an incredible body of research that looks into, the kind of legacy of obstructionism and denial, particularly work from Kevin Anderson, who I highly recommend, on, that history in preventing climate policy going forward. But that's not going to be the focus of the discussion today, which is really on what is this emerging trend of industry, particularly finance, in a genuine way, I believe, trying to engage with these crises and trying to basically crawl inside the heads of those at the helm of this kind of green capitalism movement to just ask, how do they perceive this problem? How does capital understand this problem? Is that an issue? Is it creating positive or negative outcomes, and why? And so that's just a brief kind of outline of where I'll be taking this today. So very obvious opening question, what is green capitalism? Again, I have greenwash detected here. This is what we tend to think of as the main kind of problem in sort of a green capitalist framework, this idea of greenwash. And certainly, well, greenwash, which is broadly, this creating the impression that we're doing something green when in reality that's not happening. That's certainly an issue, but for me, that's not the core of green capitalism. For me, green capitalism is captured by the widespread and widely held notion that climate and ecological crisis is best understood as a market failure and therefore should be resolved through the market. And what that means is that carbon emissions or environmental degradation, these are externalities. They're external to the market insofar as we don't price them appropriately, and therefore market actors overproduce them. And therefore, the natural solution is to sort of apply appropriate prices to those. In doing so, internalize them to the market, and in doing that, enable sort of market actors to sort of wave the invisible hand and efficiently eliminate those issues. In concrete policy terms, what this looks like is a very clear orientation on the part of policymakers. I'm broadly speaking about sort of the global north here, particularly the UK, the EU, and the US. But this means a very clear orientation towards sort of market-led and private sector-led solutions. And generally, these kind of align with two imperatives that reflect the interests of the private sector, and particularly a sort of cohort of private sector actors, particularly in finance, at the sort of top of the power pyramid. And that is to sort of minimize systems transformation. So I'm talking about minimizing disruption to sort of global capitalism in all of its complexity, whether that's the institutions that govern it, whether that's the distributions of wealth and power and capital allocation that define it. And the second aspect is ensuring that climate and ecological policy is a vehicle for sort of maximizing new opportunities for profit and new areas for financial return. And this comes out of the genuine recognition on the part of those at the helm of green capitalism that the climate and ecological crises are genuinely an unprecedented threat to the ability of sort of capitalism to reproduce itself. So genuinely recognizing that threat and wanting to deal with it, while also recognizing, and again, I'll borrow from Larry Fink, who I quoted before, that the process of decarbonization is going to be the greatest investment opportunity in our lifetime. So ensuring that all the policies that we pursue are complying with that sort of drive to maximize opportunities for profit, and that policies are appraised through that lens. Something that is going to be a sort of profitable and not a loss-making policy venture is one that is perceived as good and worth pursuing on climate and ecological crisis. So today's lecture, I'll just walk you through a couple of these kinds of totemic policies to really get an idea of how this is manifesting. And this here, briefly, is just an image of the kind of framework, and hopefully everyone can read that, from COP26 in Glasgow last year. This is the Finance Day kind of publication, and I think it really captures this logic really perfectly, which is, in order here, the sort of priorities for transforming global finance, which is improved reporting, risk management, so ensuring that we minimize risks to the financial system, maximizing returns realized from the, and I quote, enormous commercial opportunities in the transition to net zero, and last but not least, actually kind of mobilizing private finance to deliver some of the outcomes that we've seen. But again, with a key text there being new market structures and public-private partnerships, again, ensuring that we use the power of the state to sort of undergird the private sector's efforts in this space. Okay, so if the overarching framework is that we need to render these problems market compliant, we need to internalize those externalities to the market. That means that we need to find a way to give carbon, or we need to give sort of ecological damage, the biosphere, ecosystems, a price, an appropriate price. Leaving open the question, how should we determine that price? Because unlike a conventional good or service in the market, this isn't an issue defined by kind of supply and demand in the conventional sense. And so, policymakers have set themselves the task of trying to construct a price so that we can find ways to evaluate or sort of engage with these crises through the market. And here I quote William Nordhaus, who's sort of the most famous kind of climate economist, when he quotes that good policies lie somewhere between wrecking the economy and wrecking the world. And this here is a graph of his very famous kind of DICE model, which stands for Dynamic Integrated Climate Economy Model. It is an integrated assessment model. Apologies, economists love acronyms, et cetera, particularly in the climate space. But broadly, what DICE tries to do is to evaluate the trade-off between action on curbing emissions and global GDP, understood as meant to be an indicator of sort of economic well-being. And if you look at the sort of orange line here, you'll note that Nordhaus's model prescribes an optimal degree of global temperature rise to be 4 degrees Celsius above the baseline. And that is from the perspective of sort of the economy understood through GDP. I think many of us would know that science would describe 4 degrees Celsius as nothing short of catastrophic. But for me, this really highlights the kind of difficulty in reconciling the challenge faced by climate ecological crisis with sort of standard mainstream kind of economic thought and models. And green there is sort of the 2 degrees and definitely not optimal from this perspective. But the reason that I share this without getting too bogged down with the kind of mechanisms of the model, although I should say that one of the early efforts that Nordhaus made at evaluating this excluded roughly 90% of economic activity from the analysis under the belief that it takes place in carefully controlled environments, in other words, indoors, and therefore wouldn't be affected by climate change. Obviously, an assumption that a lot of people have since taken issue with. But without sort of getting too bogged down in the modeling, the reason that I'm showing you this is that this kind of analysis and trajectory has come to inform the scale of our ambition and critically the way that we think about sort of pricing and market mechanisms, with these trajectories informing what economists and policymakers decide to be, an appropriate kind of carbon price, and how we should be thinking about penalizing emitters and actors in the marketplace for their role in contributing to emissions. So I guess to begin with, I'll speak about carbon pricing as very briefly. There's a whole chapter on it in the book, and I could probably give a whole lecture on carbon pricing, and I'll just use it here to introduce, again, this kind of idea of market mechanisms as the guiding force for policymakers' response to the climate crisis. Many people are probably familiar with climate pricing, whether it's cap and trade, or carbon pricing rather, whether it's cap and trade or carbon taxes. Broadly, the EU's emissions trading scheme being the most familiar with these mechanisms. Again, the idea of carbon pricing, much like the rest of kind of green capitalism, is to internalize the externality of carbon to the market with a clear price signal imposed that will sort of prompt actors to curb and eliminate emissions. And there's a real sense of intuitive fairness to this idea, which has also made it popular, which is this idea that sort of, sense polluters will pay by applying sort of a single price to all sort of sources of carbon. Unfortunately, there are many reasons to believe that carbon pricing schemes don't live up to this kind of hype, as it were. Again, can't go into them here entirely, but there are 3 sort of key principles that I think are sort of constitutive of green capitalism and my questions around market-based approaches to the climate crisis as a whole, which is that first, price signals and markets in general aren't designed for systems transformation, which is ultimately the question that we're facing with the climate crisis when we consider the embeddedness of fossil fuels in every aspect of the infrastructure of the global economy. And so this is a question of systems transformation, which is one that the price signal is not optimized for. Instead, it is designed to sort of optimize the existing system from a cost efficiency perspective. And for this reason, a lot of the outputs of carbon pricing schemes to date have broadly been sort of modest efficiency improvements or a shift from coal to gas power. These are sort of impermanent tweaks to optimize the existing system we have, rather than begin the much more challenging process of complexity of planning a transformation of systems as a whole. So that's principle one. The second is that there's really no true sort of price signal that we can arrive at that can represent the damage that carbon emissions do in an appropriate way. You know, I showed you the DICE model previously, which informs some of this. You know, economists around the world in surveys tend to give hugely varying estimates of what an effective carbon price should be, ranging from $40 a ton to $14,000 per ton. And for the record, you know, as of the most recent IMF estimate, the actual global carbon price on average stood at about $2, so not even at that kind of lower bound. But the important point there being, you know, there is no kind of price signal that can really accurately sort of render these issues market compliant in a way that can drive the kind of effective outcomes we care about. And the third is that broadly capitalism is an externalizing machine. And I borrow that quote from Servaas Storm, who's an academic. And what I mean by that is that, you know, when we impose these new costs on actors in a market, because they are profit motivated actors, they will find new ways of reducing costs elsewhere. In the case of carbon pricing, this has been broadly in the proliferation of sort of carbon offset markets rather than true deep emissions cuts, which has created not only questions around serious greenwash and sort of ineffective emissions cuts, but also new problems in the form of sort of major questions around the displacement of indigenous communities, subsistence farmers, and traditional economies around the world, major problems for biodiversity, and several other kind of factors that come out of this new externality produced by trying to solve this through a profit-motivated kind of market mechanism. And setting a carbon price aside, which, as I said, could be a lecture unto itself, those are kind of the three pillars that define my issues with sort of green capitalist solutions. And critically, despite the fact that carbon pricing schemes to date have broadly had sort of lukewarm / tepid results for a myriad reasons, that same logic around optimizing price, optimizing risk, and leaving this to the market is very much being applied to kind of new domains. And this is the area on which I focus, which is the application to the question of biodiversity loss and ecological crisis. So the title of the book is What's the Value of a Whale? That doesn't come out of nowhere. Broadly, that relates to a study shown here, which came out of the International Monetary Fund, where they tried to arrive at an appropriate dollar value for a whale based on their sort of economic contribution. And they sort of arrived at roughly $2 million US, a nice tidy sum based on their contribution to carbon sequestration, as well as sort of ecotourism, so broadly whale watching tours. And this example might sound a bit outrageous, but the critical point I want to make is that this is an increasingly sort of central policy agenda that is neither new nor fringe. So like carbon before it, the way that we are approaching the much less sort of studied, at least in a public policy sense, question of biodiversity and ecological crisis is following the same idea of finding ways to internalize the externality of ecological degradation to the market through the price mechanism. And again, trying to represent the importance of stemming biodiversity loss through its role in supporting the capitalist kind of market economy. So the slide just shows a couple of sort of examples. No one has left this kind of untouched, and whether that's, major insurance firms putting forth their own estimates, or here the World Economic Forum, who estimated that half of global GDP is moderately or highly dependent on nature. I always wonder what would happen to the other half of GDP were we to experience a total collapse in biodiversity. That's sort of beside the point. There are two major sort of threads in this space, one of which is natural capital accounting. So that is trying to arrive at a dollar value for kind of stocks of natural assets that we have around the world, whether that's forests or fresh water bodies or sort of mineral resources. And the other is ecosystem services, which are those services that the environment currently provides to us freely, whether that's disease resistance or pollination or, breathable air. The key question here is that the price signal, again, is trying to arrive at this question of equivalence, so that units of these natural capital units, these assets or ecosystem services, can be traded on the market in a way that is meant to reflect their sort of ecological importance. And that, again, rather than simply sort of trying to regulate or trying to sort of reduce ecological loss in the first instance, the best way to address this is to arrive at appropriate prices and allow market actors to sort of trade in equivalent dollar values, understood through the contribution to the economy of different kind of assets or services. Again, not a fringe kind of issue, a major focus at this coming biodiversity COP in December. Also a new sort of landmark national strategy with the Biden administration, who are trying to set up natural capital accounts to go alongside sort of GDP accounting. And as of 2018, which was the last sort of peer-reviewed estimate I could find, the market for ecosystem services around the world, which is a voluntary market, was already sort of 40 billion in trades. And the real issue here is that, like carbon pricing before it, which has had sort of lukewarm results for myriad reasons, it's even more so for the questions of sort of ecological and biodiversity loss. One study from the Nordic Council of Ministers looked at 500 biodiversity offset projects, some of which try to trade based on the actual sort of quality of an ecosystem itself, so a swamp for a swamp, simplistically, but many of which also consider trading based on sort of economic equivalence, again, sort of based in price terms. And their results were nothing short of staggering, finding that in the projects under study, the areas experienced a 99% loss in habitat based on these biodiversity offset programs, which broadly say, if I destroy a swamp here, then I will pay to protect or restore something of equivalent value over here. And just to dig into some of the kind of methodology of this, which really focuses on the question or the pillar that I raised before of the fact that for many of these issues, they can't be rendered market compliant because there's no legitimate way, I think, to reflect or to construct an at all representative sort of price. So this shows a table of methods from a recent US government publication showing their sort of best practice on how to arrive at values for ecosystems. And some of the sort of methods, if you'll look there, include travel costs. So how much are tourists willing to pay to visit an ecological site, or hedonic pricing, my personal favorite, which basically says, a lakefront property is worth more than a property elsewhere, and therefore lakes should be considered more valuable when we go about pursuing sort of policy or having market actors trade in these kinds of services. And here I'll just direct you on this, which is a summary of their sort of overall values of what different ecosystems are worth. If you look down at beaches and dunes, you'll note that it's sort of an order of magnitude above all the other kind of areas, whether that's forest or coastal wetland or coral reefs for that matter. How did they arrive at this, you might ask? This shows one of the underlying sort of methodologies, which is that when we appraise the value of nature and biodiversity purely from an economic perspective, then questions such as aesthetic value, shown here, or tourism tend to absolutely dominate relative to many other questions that actually relate to sort of sustainability and the sort of protection and conservation of the biosphere and of ecosystems. So again, here, this is for me another example of the sort of incompatibility in many critical instances of market-based mechanisms and the price signal with key issues surrounding sustainability and decarbonization. And yet, despite this, these are kind of the methods that are being pursued headlong. And this is how, policymakers the world over are in many cases sort of appraising these problems and how they should design policies. So for me, it's important to understand sort of the methodologies and mindsets going into them. And the key point is that a lot of this is being directed towards finding ways for the private sector and particularly private finance to invest. So this is just a landmark report that came out, I believe, in 2019, which was, to show kind of its influence. It was endorsed by everyone from Mark Carney to the managing director of the IMF to John Kerry, Mario Draghi, basically all the world's kind of big mainstream climate policy denizens. And broadly, it endorsed these approaches, as well as construction of new ways to crowd in sort of private sector investment through new kind of green financial products, which they estimate by 2030 could be up to 90 billion a year. And really advocating the use of the private sector, or the state rather, to support the private sector in making these investments, and to find sort of appropriate methodologies and pricing mechanisms for doing so. So this brings us to the last kind of policy area I'll talk about, which is the real money-making hub of green capitalism, which is the investment industry. Many of you may have heard of the boom in kind of ESG, or environmental social governance investing, sustainable investing, whatever you want to call it. These are just some charts highlighting the kind of explosion of this industry within private finance, which is broadly sort of predicated on this idea that with some small tweaks, we can all do well by doing good. Again, minimizing sort of major changes to or regulation of the private sector or the financial system as it currently exists. And this idea that with better information, with better kind of pricing, the sort of finance industry can deliver net zero by 2050, or whatever your climate and sustainability goal might be. Again, important to kind of look under the hood. The promise of this, as I said, is that capitalism can be appropriately tweaked so that saving the world need not be sort of irreconcilable with having, booming finance sector and great returns to your portfolio. This is just a study by Bloomberg, which looks at the boom in something called sustainability-linked bonds, which is now a key part of this industry. As you can see, they've kind of rapidly overtaken all other forms of sort of corporate bond issuance, shown in purple there. The problem is that they broadly come with kind of no requirements over how that money is kind of spent. They're usually linked to targets related to reducing carbon emissions from companies, except as we look here, they're broadly tied to scope 1 and 2 emissions overwhelmingly, shown in purple, when the vast majority of emissions are in fact scope 3, which is broadly like end use of products. This is sort of a side example, but just an example of the kind of greenwash that people often say is kind of the critical question here. For me, the key issue with sustainable finance is not always this greenwash, but is what is much more kind of a feature of its logic rather than a bug, which is, again, much like creating appropriate sort of prices so that market actors can deal with sort of trading in carbon or different elements of ecosystems. The key for finance is appropriately pricing kind of financial risks so that we can arrive at appropriate valuations for different investments under this idea that, with adequate information, financial markets will be efficient and allocate capital appropriately. And fundamentally, this is about questions of financial risk, not necessarily the role that financial firms have in driving material risk. What I mean by that is you can think of it as kind of ask not what your portfolio can do for the climate, but what climate will do to your portfolio. And this here is just showing research from Commonwealth, where I work, and there are many such examples where this isn't necessarily a question of fossil fuel firms peeking their heads up in sustainable funds. That's a problem, sure. But broadly, this is an average of several climate-themed kind of sustainable funds, and they tend to be packed, even when there aren't fossil fuels, with sort of just finance, industrials, big tech, big pharma, all things that we probably don't necessarily think of as associated with transition to a sustainable, decarbonized economy. And broadly, again, this is sort of a feature rather than a bug of the kind of financial market-based logic, which is that the goal is reducing finance's exposure to the risks that might derive from investing in a fossil fuel company, rather than in actually driving forward a green transition. And so it's best thought of as sort of betting on the likelihood of a more sustainable future, rather than trying to contribute to building it. And a great study that I love that kind of emphasizes this logic is there was an analysis of hundreds of funds based on the Russell 2000 index, which is an index of 2,000 companies. and they looked at the sustainable or ESG versus sort of mainstream funds based on that index, and found that the single biggest difference statistically by several orders of magnitude was that the sort of ESG funds, the ethical funds, were invested more in the companies with few or no employees. And broadly, the reason for that was that if you don't have employees, you don't have risks from sort of labor disputes or human rights violations. And so you've eliminated that risk, and therefore your fund is sort of ethical. Obviously, that's a fundamentally different question than actually sort of trying to drive forward improvements in labor rights and wages, et cetera. And that's kind of the overlying logic of this industry. Going to skip ahead. So as a brief stock take, I just sort of ran through there probably too quickly, several different kind of policy approaches that are at the helm of policies, whether it's the UK or the US, the EU as well, and found, broadly, there are sort of flaws in the design or the underlying logic that, in my opinion, make them sort of incompatible with delivering on their promise. And in the process, creating new injustices or problems and externalities, whether that's, devastating outcomes for biodiversity or land grabs associated with carbon offsets and beyond. So why is it that these are sort of the core policies we're pursuing? Why is sort of green capitalism the emerging framework? Lots of answers to that question. And again, there's brilliant work for beyond all the reasons that we're trying to sort of fail to bend the emissions curve, again, related to obstructionism, lobbying, denialism. But again, for me, a critical issue is that, is that the green agenda being sort of driven forward is one that is actually kind of in and of itself unable to deliver on these challenges. And so the question then is who is driving it forward? And this relates in a lot of ways to sort of shifts in how sort of Anglo-American capitalism has been oriented over the past several decades. So I'm just going to briefly do a little historical zoom out. So this first chart here shows just the explosive growth in the kind of value of listed equities, so financial assets, as well as real estate assets relative to sort of GDP shown in red. And broadly, this is trying to communicate a trend in the US economy, but the same goes for the UK and slightly to a lesser extent the EU, in this reorientation in a really powerful way of capitalism away from sort of income from sort of work and productivity being the primary driver of sort of growth, as well as of economic outcomes and security for individuals, and towards asset ownership, whether that's real estate or other forms of financial assets, being sort of very constitutive of your position in the economy, of your economic security, and also being the primary driver of sort of growth in many economies, and therefore a key sort of policy target of policymakers. So that's sort of the kind of long view there. This is just showing, again, the declining labor share of GDP in the US with a commensurate, massive increase in the sort of capital share over the same period. So this has, again, created sort of financialized economies, vast literature on financialization of global capitalism, which originated with sort of the explosion in the power and the balance sheets of banks. But since the 2008 financial crisis, and with the kind of increasing orientation of our economy towards asset ownership, has driven the explosion of a very powerful kind of new industry that is acutely interested in policies surrounding climate and sustainability, and that is the asset management industry. This is Larry Fink again, who I've mentioned before. This is sort of a new site of immense power in the global economy that I think is at sort of in the driving seat of green capitalism, and will be highly constitutive of many of the policies and approaches that we continue to see coming down the line. So asset management industry broadly does what it says on the tin. For those who don't know, asset managers will manage your assets on your behalf for a fee, whether you're a pension fund or university endowment or an individual investor. Anyone with assets will hand it over, and for a fee, an asset management firm will invest it on your behalf. Since 2008, there's been not only a massive explosion in the absolute size of this industry, broadly as a result of growing sort of economic inequality, but also a shift away from banks and towards other forms of financing, such that the industry is now, or at least pre-COVID, was about $100 trillion global industry. But critically, there's also been a massive increase in concentration within that industry, such that three massive US firms, BlackRock, Vanguard, and State Street, now control sort of 20% of global assets under management, and about 20% or more of shares in the average sort of S&P 500 corporation, which is all the big US corporates. Critically, they're exposed to different types of assets all throughout the entire global economy. And this makes them uniquely exposed in many ways to the impacts of the climate crisis, and therefore genuinely interested, in my view, in resolving it. And so not only do they have an acute interest in addressing this problem, but they also have an acute sort of concentration of power, which puts them in a unique seat in terms of driving forward sort of policy, as well as sort of the behavior of the corporate sector. The question then that begs is, what do asset managers want? How do they think? What are their imperatives? And how is that shaping sort of green capitalism and the policy program coming out of it? So to answer that, I apologize, but this is just a Bank of England chart. I will briefly go into sort of one more technical point, which is how much of this concentration and growth in asset management has been driven by what's called passive investing. We tend to think of investing as sort of Wolf of Wall Street-esque, with traders kind of yelling at each other and trying to beat the market. Broadly, over the past 10, 15 years, there's been a huge shift away from that kind of investing and into passive investing, where instead of having individuals pick stocks, broadly, you are tracking an index, whether that's a list of, the S&P 500, or you're tracking the entire global mining industry, or just the European mining industry, etc. You sort of yield decision-making power over to this index because broadly tracking the market as a whole has outperformed. And so this has been sort of explosive and driven the ascent of BlackRock, Vanguard, State Street, one or two others who tend to have sort of massively cornered kind of the market of this form of investing. And what this has done, again, is change how capital is allocated in the global economy and where sort of power sits over that capital allocation, over sort of shareholder governance rights, and again, over, frankly, political clout related to the influence of the finance sector over politics. So as it stands, passive investing is so concentrated and so powerful that it's no longer just kind of tracking markets or trying to represent them, but is broadly sort of influencing them and sort of making them itself. And this is increasingly important for sovereign debt, particularly with respect to countries in the global south, again, which is sort of critical for not only mitigation of climate and sustainability questions, but also adaptation. So relative to traditional forms of lending like multilateral development banks, private investors driven by the asset management industry are increasingly a critical source of finance for emerging market economies. And a lot of this is driven by passive investing. And so the left shows a study which found that sort of passive investing has, again, been sort of destabilizing the sort of debt structures of these countries by creating much greater volatility insofar as if you have a small change in an index, then you have massive flows because everyone following that index needs to change their capital allocation. And so all of this is just to say that there's been sort of a real shift in power over investment towards this industry, which has major implications, again, for the way that green capitalism progresses. So I'm getting to the end, conscious I have just a couple minutes left. So why am I telling you this? Broadly, this comes back to a question of what do asset managers and associated industries like the index providers want? In an asset-driven economy, those controlling assets and sort of representing the interests of those with assets are genuinely threatened by the climate crisis, but also understand it as an unprecedented opportunity for new sources of returns. At the same time, the ability to control where money is invested is increasingly constrained, in large part due to the nature of passive investing, and also in large part due to sort of other constraints like the fact that just having massive stakes makes it harder to liquidate them. That's sort of beside the point. So to sort of get through this jam, for major investors, particularly for BlackRock, the key has been politics and broadly shaping climate policy in their interests. And this isn't truly just conspiratorial. You know, BlackRock is now advising the UK Treasury, but much more importantly has senior roles throughout the Biden administration. You know, different publications have joked that Larry Fink has tried to set up his own sort of shadow kind of government over the years. They had a role in the Federal Reserve's COVID-19 asset purchase program. They had a role advising the EU on this sustainable finance legislation that would sort of govern themselves. And so they've taken an acute interest in influencing politics in a way that sort of benefits their interests directly. And all that to say is that there are many ways that the climate and ecological crises could be resolved. And for BlackRock, the way that it has to be resolved is a very particular one in which any kind of pursuit and policy mechanism that doesn't create new investment opportunities and doesn't sort of undergird the returns of the private sector and new sort of assets is sort of anathema to their model. And this is showing up in the imprints of policies all around the world, whether it's the EU Green Deal, which broadly views the role of the state as, again, de-risking investment opportunities for private finance, as well as in various packages that have come out of the Biden administration. And the way that I always try to concretize that idea is that if we think about changes in sort of transportation, absolutely decarbonizing transport is a critical task. There are many ways you could do that. Broadly, you know, material constraints mean that we can't sort of just replace all sort of electric or all current vehicles one-to-one with electric vehicles due to questions around mining and human rights and land use, et cetera. And broadly, we need, you know, a massive step change in mobility and a move towards sort of decommodified mass public transit, et cetera. All of these things are sort of antithetical to the imperatives driving green capitalism, which is why, again, we see so much focus on policies that can support sort of profitable and profit-making ventures in the transport space, most saliently sort of the proliferation of electric vehicles, rather than looking at other forms of transport that may or may not be sort of less profitable. This is just one kind of micro example of a broader trend, again, in policies where everything is appraised through the lens of profitability, and anything that isn't is sort of counted as a policy that is not worth pursuing. This is a niche kind of slide to just say that, interestingly, this sort of pursuit of climate politics and of policy shaping on the part of the large investment firms, and particularly BlackRock, is beginning to sort of come back to bite them in the kind of woke capital backlash is increasingly sort of gripping the far right. And so much to be seen as to how constrained they will be in continuing to try to overtly shape climate politics and sort of the climate and sustainability agenda in the way that they have. Open question. So just to return and kind of summarize, ultimately, the core issues of green capitalism relate to the nature of its orientation around the market as the only mechanism for resolving these crises. We've walked through kind of issues with the price signal and its incompatibility with certain aspects of these challenges. But for me, much more fundamentally, there's a core issue of green capitalism and sort of market-based solutions insofar as they just refuse to grapple or are ill-equipped to grapple with kind of critical forces driving climate and ecological crisis in the first instance, which is sort of massive inequalities and indefensible inequalities in global kind of wealth, consumption, resource use, waste. And in an asset-oriented economy dominated by sort of asset owners in a tiny cohort of the global north, as shown here, you know, policies that are best serving their interests broadly are not necessarily those that will serve the interests of, you know, the globally poor majority. These interests are often in direct conflict, with the EV's example being just one of them. And, you know, there's an unwillingness, I think, to grapple with uncomfortable realities around sort of global inequality and its relationship to sort of material throughput, as well as to emissions, where they come from, what the sources are. This is both a question for me of sort of quantity and sort of a qualitative issue. And this final chart here just shows, the final chart here just shows the sort of inability to decouple thus far global sort of material throughput from GDP, which is for me an open question around redistribution as sort of being at the heart of this problem, and one that sort of market mechanisms are sort of fundamentally disinterested in or incapable of engaging with by design. And I'll just leave you with one of my favorite quotes from BCA Global Investment Solutions, which says, "The risk of Armageddon has risen dramatically. Stay bullish on stocks over the next 12 months." And there we go. I think I broadly stayed on time there. Sorry for rushing through a number of points to try and meet the time limit.
Great. Thank you very much, Adrienne. That was an absolutely fascinating talk. And it will definitely stimulate your questions, and I can see them in front of me now. We've got about 15 minutes. I might, if I may, I'll ask these questions first, but I'll come back to the Mark Fisher question perhaps at the end, Adrienne, which is whether it's easier to envisage the end of the world than the end of capitalism, and if you like, the sort of structure and framework for how one might begin to address these problems, the role of the state, public ownership, etc., in that challenge. But let's go into our questions. So the first one from Dan Black is to say sort of what research is needed into the solutions. Where would you sort of, you've got academics here in your audience, where would you say the research should be directed? And then from James Coachstake, and in particular, I think this related to the section on natural capital and biodiversity. How far is this, the monetization and commodification of nature, how much is that corrupting, and can we view this corrupting effect as an ethical negative externality and even try to value it? But of course, this is James says, to dodge the deeper methodological challenge to the dominance of utilitarian thinking. So the question is, what's the is the natural capital approach simply a further evolution of orthodox economics and utilitarianism that's underpinned it for many decades, and is a different kind of, therefore entirely different way of thinking about nature appropriate? Should we just simply reject the idea of valuing nature in this way as being corrupted by its methodological dependence on that form of thinking? So there's a couple of questions there perhaps to start with, Adrienne.
Great. And I would actually broadly say they are related, so I might come to the further research area second. Great question about sort of natural capital as an idea, and one that I sort of wrestle with a lot. What's interesting about natural capital as a framing and as a concept is that it's lived many lives. John Bellamy Foster has traced its origins back to Marx and his contemporaries, looking at the fact that we don't sort of value nature, although Marx was looking mostly at like soil erosion rather than biodiversity necessarily. It has its origins there as being sort of one of the reasons that we are kind of gradually eroding this shared asset that we all have. Herman Daly, who sadly recently passed away, but is quite a famous sort of ecological economist, similarly kind of revived this idea, coming from very much a heterodox perspective, which said that because we fail to recognize the kind of reliance on a depleting like stock of an asset, that sort of GDP is, we measure only this kind of flow of production, and we fail to consider the depletion of the asset underlying that. We therefore kind of fail to sort of preserve nature. And his suggestion was that in certain instances, valuing natural capital was sort of necessary in order to avoid its destruction. I think for me, the critical issue with natural capital as a framework, or issues I'll say too, is that one, that set of sort of methodological questions that I rose, and I think this comes to your point about sort of corruption of an idea, which is that, as soon as you begin to try to sort of disaggregate the phenomenal complexity of ecosystems into kind of discrete units that can be made market compliant, you end up with all sorts of issues that mean you'll probably create more harm than good. They're incredibly sort of anthropocentric measures, and all sorts of questions there that I do think represent a real kind of problematic departure from what nature and ecosystems and biodiversity, sort of what those actually are and represent, which is much more than just their sort of crude contribution to, GDP, which is broadly how it's often understood. And the second is that, this approach as it stands is primarily being championed as a way to create, again, new financial assets. And so the sort of proliferation of efforts at new accounting mechanisms has gone hand in hand with, as in that Paulson report, sort of new mechanisms for converting those valuations into investable products for the private sector. And again, there's little evidence to suggest that will have like better outcomes for biodiversity. You might have a headline figure saying, X billion in green products now invested, but sort of beneath that figure, the underlying kind of mechanisms, the underlying projects it's supporting might be completely divorced from actually kind of preserving or restoring nature. And for me, that relates to the first question around sort of areas for research. I mean, there are many in writing the book, which again, much of this was 2 years ago, and a lot has evolved and changed since then. One of the key areas for me that is missing is exactly what an alternative system would be if you are, or for valuing nature, that is, if you are to start from the premise, which people may contest, that we live within a capitalist system that is overwhelmingly kind of difficult to append and unlikely to be appended in any kind of short time frame. Working within those constraints, what would be a viable way to actually appropriately kind of reflect the immense value, not just economically, but in other senses, of the kind of natural world and its contribution not only to human life, but other forms of life, planetary stability, etc., that doesn't require sort of a price mechanism? And how would that work? How could that be made robust in a way that it was kind of received by those in power, by policymakers, etc.? That I think is an area that has a lot of kind of, it's broadly just kind of wide open. And the other is really tracking. I very briefly flagged the kind of idea of the state as kind of a de-risking vehicle for the private sector, rather than focusing really strongly on sort of public sector-led kind of planning, the kind of boogeyman of the planned economy, and having things be on the public balance sheet, etc. There's a lot of evidence from the kind of development space that can tend to lead to negative outcomes, both in terms of costing more in the long run, but also increased volatility for the recipients of that finance, negative kind of concrete outcomes. I think there is a less clear body of evidence for how that is playing out when it comes to climate and sustainability. So a lot of the kind of resistance to that is based off of evidence from other spheres. And so it would be great to see, really strong evidence of different kind of financing mechanisms and projects that are sort of failing to deliver or actively kind of undermining kind of sustainable outcomes that we want to see.
Great, thank you, Adrienne. Well, there's a couple of questions from Martin Foda and my colleague Aurélie Charles, which in their different ways are saying, we need access to capital. We want capital to flow into renewable, net zero, however you wish to describe it, or into genuinely protecting biodiversity and so on. And it comes, I suppose, to the question I started with. In what way can we think about the role of public authorities directing capital investment in certain directions, regulating to protect and prohibit in others? And what does it essentially is your framework compatible with, if you like, a social democratic one that says capitalism must be regulated, tamed, and directed to the good of humanity and to the good of the climate, or is it one that says actually private ownership and private property are the source of the problem here, and only through overcoming that can you go back to Mark, can you meet the challenges that you face?
Very big question. I'll try to answer it.
But it's implied by much of the discussion, I'm afraid.
Yes, no, that's great. It's also kind of the open question that the book presents itself, I would say, and kind of leaves open. I would say, in my sort of work in policy and again, through a lot of what's in the book, there are definitely areas where kind of the dynamism of the market and sort of profit motivated actors can deliver certain outcomes that we are already seeing, whether that's sort of a massive uptick in sort of private sector investment in the renewable space. All of that, I think, can and is being delivered, although largely helped by very carefully crafted kind of state subsidy and incentive to kind of deliver those outcomes. And so there are definitely certain sort of KPIs, if we can use that phrase, that are not sort of incompatible with markets. I think for me, the key is that trying to ensure that the overwhelming majority, if not exclusively, sort of policy pursuits are oriented around sort of market actors and the imperatives of the market is the real problem. And so, the idea for me that, carbon pricing should be the kind of like jewel in the crown of climate policy is problematic in terms of delivering outcomes. The idea that, again, incredibly kind of complex questions around conserving nature and biodiversity are best suited to sort of market exchange rather than alternatives is the real problem. So I guess the case I try to make is that there's going to be an enormous kind of like pluralism of policy approaches that are needed. Broadly in the sort of interim, I'd like to see a much bigger uptick in, again, sort of strategic public kind of planning, regulation compared to what we have now, which is that it's much easier, frankly, from a politician's perspective, to leave these decisions to the diffuse kind of actors of the market, because sort of accountability for things perhaps going wrong is therefore diffuse and not sort of attached to a specific clear public policy direction. I think that comes from sort of years of inbuilt fear around sort of how policy is perceived by the public and the thorniness of politics. So from a realpolitik perspective, I absolutely think there's a pluralism of approaches, but we need a really strong shift towards sort of clear public kind of regulation and investment. And I think the IRA, the Inflation Reduction Act, from the Biden administration is a really interesting example in that respect, insofar as for the first time in American climate politics, there was a complete step change in the direction of policy away from carbon pricing, which has always consumed American climate politics, and towards a public sector investment-led approach. I think that's a really interesting development, the return of industrial strategy, et cetera, one to watch. Lots of other problems with that legislation that people have pointed out, but that to me was a really interesting shift. In a broader sense, to the social kind of democratic question and the end of capitalism question, I think when we look at policies from the perspective of the UK and what's been achieved in terms of renewables, or the US, or wealthy countries broadly in isolation, definitely this kind of pluralism of approaches can work. And, there's nothing kind of irreconcilable about sort of a capitalist social democracy and pursuing decarbonization. It's when we get to the sort of global level that I think the real challenges arise, which is just that, capitalism by design is disinterested in sort of inequality. Broadly, it thrives on sort of creating ever expanding inequalities, which are directly related to escalating emissions, resource use, questions that, can't be grappled with by a market, and arguably sort of can't be rectified within a global economic system that resembles anything like capitalism as we know it now, at least.
Okay, great. Well, thank you very much, Adrienne, and particularly for answering the big question there at the end. It's a hugely important and enormous question. We've just got one thing from Robert Smart, the Bristol Energy Network, saying, will the recording be shared post-session? And I can see my colleague Laura is typing an answer to that, which is it will. We will share Adrienne's lecture. We have podcast and YouTube channel and so on. So please do look out for that and stay tuned. But it's coming up to 1 o'clock, so I'll close it there. And thank Adrienne for really fascinating talk. And I'm sure the book, is equally interesting, if that's a summary of its arguments. So thank you very much indeed, Adrienne. And I would just also say, as I mentioned at the beginning, Adrienne is a director of research at Commonwealth, a very interesting think tank, produces lots of really interesting work. So please go and check out the Commonwealth website. Lots of resources on it. Lots more in the way of research and policy argument to be found there too. So I recommend people have a look across at the Commonwealth website. But thank you very much indeed, Adrienne, for your time today. Thank you all for joining us and contributing your questions. And we look forward to seeing you again at the next IPR event. We've got a big polycrisis series this year, lots of really great speakers. So do come along and join us at future events. But thank you very much for coming today. Thank you.
Thanks so much.